Hi everyone, welcome to this webinar on the ocean market predictions for 2024. My name is Schulze and I'm the Global Head of Ocean Freight here at Flexport. I'm super excited to spend the next 1 hour with all of you. So before we get into the details, just a big fat disclaimer right here. We will stick our neck out a little bit and try to sort of predict the future. But as we all know, it's very hard. Things can change very fast. We've all been witnessing a ton of black swan events during the COVID economy. So please don't hold anything against us. What we say today may change tomorrow and may not even happen. So we'll do our best job to essentially predict what we expect in terms of ocean freight going into 2024. The agenda today, super simple. We'll start at the supply and demand level. We'll look into sort of the trends we've been seeing in the past, this year, and then going into next year, what do we expect relative to what we've been witnessing this year. Then we'll talk a little bit about rate levels, also how rates have developed over time, what we're seeing at this point in time, and then also what we expect going forward, both in terms of floating rate levels as well as contractual fixed rate levels. We'll talk a little bit about the future of ocean alliances. We've seen a lot of news the past 6 months in terms of alliances breaking up, or at least having announced that they're breaking up, as well as new regulation from the European Commission. So we'll double click on that to learn a little bit more about what all that means. Then finally, we'll talk about sort of tips and tricks, best practices for how to navigate 2024 based on the trends and the macro events we're seeing out there. But before we go into the meat and potato here, let me first introduce my co-speakers today. First off, welcome to you, Trine Nielsen, who runs Flexport Europe Ocean. Welcome to you, Trine.
Hi, everyone.
Next up, Nerijus. Nerijus Poskus is in charge of ocean freight procurement here at Flexport. Welcome to you, Nerijus.
Thanks, Anders.
And then lastly, Lars, Jensen, CEO and partner of Vespucci Maritime. Lars is becoming a little bit of a usual suspect in here because he's always delivering such good messages. So no pressure, Lars. Welcome to you.
Thanks. Good to be back.
Great. Okay. Before we get into the details, so if it's the first time you're attending a Flexport webinar, just wanted to introduce sort of the app you have in front of you right here. So it's pretty simple. You have a Q&A tab. We're not going to do a broad sort of Q&A session at the end of the webinar. Instead, we've tailor-made it for you. So if you have any questions, just type it into the app right there, and then someone will respond just to you. There's also an ability to download the slide deck if you like some of the visuals, facts, and figures. And by all means, feel free to follow up afterwards in case you want to learn more. Double click on some of the facts and figures. Happy to help. Happy to help offline. Now let's start at the high level. What's happening out there in the world of ocean freight? How is the supply and demand balance developing? It's pretty clear that this year we're coming to an end. It's pretty clear that this year has been an overhang of supply, essentially more space out there than demand that has been somewhat suppressed. This is different relative to the previous years, especially the COVID economy. This was the reverse trend, upside down, way more demand than supply out there. We expect what we've seen, in 2023 to continue into next year for a few simple reasons. We don't expect demand to all of a sudden pick up significantly based on the trends we're seeing and the macro intel. And at the same time, we're actually seeing more capacity, more supply hitting the seas. If you take a look at the snapshot here, we've shown the amount of capacity hitting the seas every month next year. If you do the math and compare that influx of new vessels relative to the existing fleet, it's an addition of 13%, which is actually higher than the historical average of 7%. But Lars, help us understand these numbers and also how to interpret this relative to historical patterns you've seen.
Yeah, because it's true that there is a relatively large order book and it is scheduled to be delivered, but reality always tends to differ slightly from that, especially when you are in a downturn of the market that we're heading into. Then you need to take into account not only scrapping, but also slippage, which is basically when, I have a vessel on order, but I might get away with, or I pay a little bit to make sure this vessel doesn't get delivered as quickly as originally planned. So realistically, you're not going to see a 13% increase in the fleet next year. You're going to see something less than 13%, maybe in the 8 to 10% range, something to that effect. From a historical perspective, that is not an extreme amount of additional capacity growth on top of demand. That doesn't mean it balances the market. Absolutely not. Make no mistake. There is too much capacity coming on stream, no matter how we slice and dice it. But this is a cyclical market, and the cyclical overcapacity we're heading into is a fairly usual run-of-the-mill cycle, that it's not a particularly large down cycle.
Do you expect more scrapping and postponement of deliverables, Lars, relative to what we've seen normally?
More likely postponement. Scrapping has been unusual even this year. I mean, we know the last 2 years there was no scrapping. That was because all ships were needed. So the expectation was for a lot of scrapping this year. That has not happened. We've seen scrapping of just 0.7%. The problem is old vessels also tend to be small vessels. And even though we have a massive order book, we haven't ordered a lot of small vessels. So there's a mismatch here between the order book that's coming in and the vessels that supposedly should be scrapped. I do expect to see scrapping pick up, but it's not going to save the day.
Got it. Very, very insightful. I think aside from scrapping vessels and postponing deliverables, one of the key levers areas that are available to essentially get closer to matching supply and demand is essentially blanking sailings, voiding sailings that are already out there. So we've seen more of that the past couple of years relative to what we saw in the history books. Nerijus, first off, if we zoom in on the Trans-Pacific trades, what have you seen lately, and how do you expect this to develop going forward?
Thanks, Anders. Looking at the graph on Trans-Pacific, it almost looks like you have more capacity today than, let's say, at the end of last year. The reality is, while the blank sailings of 15 to 20%, this graph excludes canceled services. On Trans-Pacific, shipping lines were quite good at managing capacity, right? PN3 on the Alliance, EC4 on the Alliance, MSC changed the port pairings on Santana. They merged two services into one. All of these actions are actually also reducing effective capacity, which you described in graph number 1. So what we're seeing is, again, carriers are acting when the market is low. This is probably one of the reasons why Trans-Pacific rates are holding up a little bit better than the rest of the world.
Would you agree with that, Trine, from an Asia-Europe perspective?
Yeah, I think we're seeing similar trends on Asia-Europe. So blanks are being used more extensively, and especially recently, where the carriers have been trying to push the rate increases through. So I think one of the biggest weeks recently was 30% capacity that was blanked in a week in combination with the GRI. If we look towards December, there's a new rate increase coming, and again we're looking at blanks of 25%. So I think, as Nerijus said, that's part of the picture. The other thing is winter sailing schedules that are coming into effect, strings being removed in the short term. So definitely the carriers are doing a lot to manage the capacity as effectively as possible.
Very clear. Anything to add here, Lars?
You would say the only thing I want to add is, and that's especially for Asia-Europe, less so for Trans-Pacific, the carriers' actions are, or have been during the second half of this year, in the category of too little, too late. It's only very recently they began to really ramp up the amount of blank sailings, and that's why rates were basically, they were dropping through the floor during the non-existent peak season. They seem to have been waking up now. They got their GRI through. I'm still not sure they have pulled quite enough capacity. And as Nerijus was also pointing out, they have an advantage on the Pacific. There were a lot of smaller opportunistic carriers that have pulled out of the trade. That has reduced capacity. We never really saw a material influx, at least not to a degree that matters, on the Asia-Europe trade. So the onus was on the carriers to be even more active on the blank sailings program. And that's not what we have seen, at least not until very recently.
Yeah.
I think, Anders, I would add maybe a little bit that looking forward in 2024, I would expect that this trend will continue. Carriers are likely going to have longer service loops rather than having more loops. They will have less so-called services, but they will call more ports. Why is that important for the importers? Is the longer the loop, the more it's prone to delays, right? If something happens at one of the ports, if all of a sudden you have 10 ports rather than 5, again, the service reliability goes down a lot more. I also expect when the carriers rationalize supply and demand in their services based on the expected demand, there likely will be less direct sailings. Some of the port pairs will likely lose them. I already heard from some shipping lines they are launching new intra-Asia feeder services to feed some of the smaller ports into the hubs like Singapore, Shenzhen, or Shanghai, depending on the port pair. So expect more of that to happen, and likely even some more service cancellations. Today we have over 60 services on Trans-Pacific. It's likely going to get less next year. And the last thing I'll say, it's a tough prediction, but I do predict that some shipping lines may even consider exiting trade more than they did in 2023 next year.
If I can just add a comment on that, one thing I expect to see happening, because we always see that in a cyclic downturn, at some point in time, the carriers will idle vessels to a much higher degree than what we see now. Not just blank sailings, but outright idle vessels completely, shut down services for a longer duration. The thing that is impossible to predict is when they're going to do this. That basically depends on how loss-making do all the carriers need to be before that happened. If the last major downturn, and granted that was a lot worse than what we're looking at now, that was the financial crisis, that took them between 3 and 6 months before they started to really in earnest idle vessels after the markets had collapsed. This time around, there is a different element at play. Because, and here I know we're going to touch upon it a little bit later on, but the carriers are going down a path where they are going to have to change their networks. They might even have to change some of the partners they're going to work with. And here's the problem. If I want to rationalize a service, blank sailings or even idle vessels, that is easy to do if I have a stable operating network to map that up against. But if my network is at the same time completely in flux and changing, there's a high risk that any action to blank services or cancel services leads to either far too much capacity being taken out or, which is more realistic, too little capacity being taken out because I don't have this stable backdrop of a network to operate against.
Interesting. Okay, so it sounds like 4 key takeaways. We should expect blankings to continue to the levels we've seen, more service cancellations, and then essentially more port calls per string, and then fourthly, potentially more idling, to your point, Lars. Okay, super insightful. We'll also we already started touching on rates. We'll get to that in a second, but let's first have a look at the demand outlook here. Lars, I'm not going to ask you about interest rates. Don't want to insult you here, but you're not a macroeconomist, so I'd rather ask someone else. But instead, give me sort of your view on inventory to sales levels that we're seeing here on the right side. We've seen those levels climbing the past couple of years, but they're still, seeing a slight downturn lately. How do you expect this to develop?
Yeah, I mean, I would still expect it to go down. It's one of these things when we were having these webinars, I would say a year ago, or even in the beginning of this year, there's a lot of focus on, well, inventories are being reduced, as we can see from the numbers. That's actually not what has been happening to a large degree. Inventories have been stabilized, let's put it that way. They've been pegged now at least on an inventory to sales ratio that matches what we saw pre-pandemic, but there's not really been an inventory decline. That also means that the expectation early in the year that there might be a demand boom coming in later in 2023 because you would have a rebound from an inventory cycle, that never materialized because we didn't really have that inventory cycle. As we now go forward, with the economy not being completely underwater, I don't think there is much outlook you're going to see necessarily material additional inventory declines, which of course from a demand perspective is positive because that will pull it down. but it also means you're not going to see this post-inventory correction pickup in demand that otherwise could have been expected.
Any views on that, Nerijus, Trine? Would you agree with this, or do you see differently?
I agree with this.
Okay, let's hear from our audience. We have a good amount of importers and shippers dialing into this webinar, so nothing better than some real-time intel on how you all see it. So let's do a quick poll here and learn about how you see your current inventory levels. All right, so very simple question to all of you. What are your current inventory levels? Do you have way too much? Too much? Do you have what you need? Do you have too little, or do you have way too little inventory on hand? Take 10, 20 seconds to make up your mind and place your vote, and then we'll see how it pans out. Interesting. That's very telling. 56% have what they need. 32% is now changing to 31%, too much. And then only 10% have too little inventory. What's the reactions from the group here? Any surprises?
I'm not overly surprised. This is basically also what you would expect. We came out of the period with all the bottlenecks where everything was, I was about to say eons delayed, but at least weeks and months delayed. So people had to put more into their pipelines to account for that delay. As we saw those delays to a large degree normalize over the last year, that meant inventories were too large. There was an effort to get rid of at least some of it. I'm not really surprised that this is the status where we are right now.
I'm slightly surprised. I expected a little bit more on having too little. Just 10% of the market, or under 10% of the market, has too little inventory, which means peak season may be quite soft this year unless carriers take drastic action.
Yeah. So we did a poll recently in a Europe webinar, and the picture looked quite similar. So moving from, maybe 5-6 months ago, where many people had too much, it's more now it's actually turning around that, we have what we need in place. And I think already months ago in the European world, if we can call it like that, we were talking about the fact that the peak will not come this year. So I'm not overly surprised to see this number here as well.
And you can say it's also this might sound wrong, it's a nice ending to the usual so-called peak season, which was fairly anemic this year, because it does seem to indicate that no, there was not a need to push a large amount of goods through during the peak season. It was more a matter of readjusting inventories to match the levels that people think are needed.
Definitely. Okay, let's move on to rates and how they have been developing. We already touched on it briefly, but let's have a look at some stats right here. So here you'll see a snapshot of the rate developments over time from Asia to the US West Coast, as well as Asia to North Europe. The takeaway here is basically that rates are by and large back to pre-COVID levels and have been hovering around those levels for quite a while. We all know that the COVID era was literally off the chart, as you can see in here, but rates are more in line with what we saw pre-COVID. At the same time, we know that the carrier costs have actually increased significantly relative to pre-COVID. So what's your takeaway here, Lars? Is this going to last like this? Is it going to change? Obviously, it goes hand in hand with that supply-demand balance we talked about. But,
yeah, exactly. I mean, for Asia, Europe, I would not be surprised if we are basically bottoming out, especially on the spot rate levels where we are. I could certainly see Transpac come under more pressure, especially with the overcapacity. Carriers might be tempted to throw more large vessels into the Pacific. Not that it's going to do anything good, but that's what carriers tend to do anyhow. We could see here in Q3 results that we are now up to 3 carriers that are in loss-making territory. Zim had already been for a couple of quarters, still are. Hyundai became loss-making and Maersk became loss-making as well. And it is exceedingly likely that all of the carriers, with no exceptions, will be loss-making in Q4. The main question is only for how long do they want to remain loss-making, and that's linked up to what I mentioned before. At some point in time, they're going to have to idle vessels, but we're clearly not there yet.
Interesting. You see it the same way, Trine and Nerijus? Any insight?
Yeah, so I mean, if we look at the data on the Asia to Europe, obviously there's a bit more room for the rates to go down. But I agree with Lars because from a carrier perspective, I think the notion of going into a price war, which happened many years ago, and where all the carriers were bleeding, I don't think that will happen again. So I rather think carriers will really actively try and manage the capacity to avoid staying in the red zone. So, you know, with all the things going on in Europe at the moment that we'll also touch upon a little bit later in this webinar, potentially there will be some disruption that means that the rates could go a little bit lower. But the notion that we see as well is that we don't expect the rates to go much lower than where they are now, or have been over the past 3-4 months.
Yeah, if I can just build slightly on that, I mean, I would tend to agree with you. The baseline is not for the carriers to go into an extremely destructive price war. However, looking at past history, it's also a scenario that has a non-zero probability. Last time we had one, just to remind people who were there and the ones who haven't seen it before, the last price war, when it reached the depths, that was in the beginning of 2016. And it's one of the most vicious ones that I've seen. You are at a point literally where base rates from Asia to Europe were zero. You were at a point where, and this sounds absurd, it was a forwarder in the UK I was in contact with at the time. They were offering zero base rate, plus they would give the shipper £10 in hand in cash if they were to book. That's how ridiculous the market became back then. Obviously didn't last long, and it actually led to the carriers regrouping into the alliances we have now and bringing stability. I'm not saying this is where we're headed right now. There are no indications we're going to see something that destructive. But it only requires 1 or 2 major carriers to want to take the market to that situation. Then everybody will be forced to follow through.
And I would add, just to make it a bit more interesting, because for the audience that is not shipping just on these lanes, while, let's say, Asia-US West Coast rates are at pre-pandemic levels, they are above fixed prices for last year. I think there is room for reduction still on the West Coast a little bit. East Coast, Asia to East Coast, and that excludes India, is actually under, right? The prices are very low. Asia to LATAM, on the opposite, is actually very profitable for the shipping lines to this day. Transatlantic, which is Europe to US, is very much loss-making for shipping lines. And the last one I had was India. India, which is a very fast-growing market, we're going to get to that a little bit later. Prices from India to US East Coast are way under what they were pre-pandemic. They are like in still 4 digits, but getting towards 3, and that's East Coast, right? So it's quite a journey. Where the West Coast, if you're shipping from India to the West Coast, it's essentially an add-on for Trans-Pacific, because mostly cargo is transshipped via Singapore. So if Singapore to West Coast is 1,600, then India is going to be 1,800 or 1,900. Just my message is, it's not as simple as averages. The devil is, as always, in the details.
Yeah, different from trade to trade. True. Okay, aside from, trade by trade dynamics, it's always interesting also to look at the comparison between floating and fixed rates and how they've developed sort of over time. So we've done a bit of an analysis here where we've shown how the Asia to West Coast rates have developed relative to the fixed rates. So the floating rates are shown in the green, and then we've done the same analysis for Asia to Europe, showing how those rates have developed relative to the fixed rates on Asia to Europe. Let's start Asia to Europe. Trine, what are we seeing here, and what has happened lately?
Yeah, so what you can see on the dark blue line here is the effect of the recent rate increases that are being pushed by the carriers. And as you'll also see, they drop, or we call it mitigate, pretty quickly after. So I think what we're seeing is sort of the fixed levels are averaging more out with the floating levels compared to what we saw last year. And I think the trend of the rates going up and down, of course, depending on how the carriers decide to manage the capacity overall. But I think it will start easing out or averaging out as we look into to 2024, where in 2023, having a floating rate has actually been a decent deal for many companies, where into 2024, the fixed rate could start actually averaging out if you also want a bit of dependability and reduced admin in your rate agreements.
Yeah, and then on Trans-Pacific, we're seeing a slightly different picture. Same pattern, but the floating rates have actually been higher than the fixed rates the past couple of months, as we talked about a minute ago. Anything you want to add there, Nerijus, in addition to what you already mentioned?
I would just say, I think while they are a little bit higher on, let's say, US West Coast, they are lower on the East Coast. And the average of Trans-Pacific as a whole is probably a wash, whether it's fixed or floating. At least this year, given how many disruptions, service cancellations, and blank sailings you have, my recommendation, and I'm getting a bit ahead of the recommendations, but for this slide is don't try to choose what's better. Like, you just stick to one. If spot, for example, is a great way to avoid the blank sailings and be able to sail as fast as you can. Fixed gives you a certainty, you know that it's the same carrier every single week, and maybe you choose a service that doesn't have a lot of blanks, and it's not that you're going to win one way or the other on rates unless there is a black swan event. And if there is one, even fixed rates, like we all saw in 2020, will likely go out the door.
There's also the alternative where you sign up an index-based contract, right, where you get access to fixed capacity essentially at a rate that follow the market indices, right? We've seen a lot more of that lately on Trans-Pacific. It's been a thing for decades in Asia, Europe, but we've seen a lot more on that on Trans-Pacific, right, Nerijus?
Indeed. And I think that trend is likely going to continue. It essentially gives you access to all of the sailings. You don't have to worry about blanks. You don't have to worry about having the right price. You just follow an index. So it's actually a win-win. I would encourage more people to explore that next year.
Yeah, it's a good alternative. Okay, let's hear from the audience again. A quick pulse check on based on what you're seeing right here. How would you think about signing up fixed versus floating rates going forward? So we have another simple question for you right here. Based on how market rates are settling, are you leaning on signing more or less of your volume on fixed contracts relative to the past? Do you plan to sign on more volume on fixed contracts, less on fixed contracts, the same amount, or don't you plan to sign fixed contracts whatsoever? Take 10 seconds or so, make your vote, and let's see how it pans out. All right. Are you surprised about this, Lars, when you talk to your many clients out there? Is this in line or different?
Yeah, I'm not really surprised. I mean, my take of, and again, this is for a very broad segment of the market, right, is a recognition we are heading into a normal cyclical downturn. There's an expectation we probably haven't bottomed out from a cyclical perspective yet, which means if my sole perspective, again, let's forget all the lessons from the pandemic about supply chain resilience. If my sole perspective is I just want to get it as cheap as possible, in that case, I would want to ride the wave down a little bit longer. But of course, as always, the danger is, when will the ride end? When will this start to turn? It will start to turn when the carriers idle vessels. But if the carriers are then already idle vessels, it will be too long to lock in the rates at the low level. So it's a gamble, but for now, I'm not surprised at the results we're seeing here.
Yeah, and it obviously always depends on the price, right? If we're talking the $0 example you mentioned a minute ago, Lars, then I think everyone would want to sign up more fixed contracts. So, nor is that going to be the case, I think. Any reactions from you, Trine, on how this poll panned out?
I mean, I think everything is up to one's own preference and company strategy. I think personally, maybe I'm more risk averse, but I would actually think it's a good time to sign on more fixed deals. So I expected that to be a little bit higher, but that's probably just me looking at low admin, less risk, let me get it locked in because we don't know the future. And maybe that's also in a European context, of course.
That's what I was going to say. European context is probably true. And most fixed contracts in Europe, I don't know, most is the right word, is quarterly, right? Not 1 year. So even your fixed rates, they aren't fixed for that long. So for Europe, I would tend to agree.
Yeah, there's a good mix. Yeah.
Different trade dynamics for sure.
And maybe just as a slight side comment here, it's not only a matter of price. If you want to sign up, and this is again more relevant with a 1-year contract over in the Transpac, if you as a shipper want to say, let me sign a 1-year fixed deal, you got to ask yourself, what is the product you're buying? If the expectation is that the carriers will all change their networks perhaps more than what we usually see, you have no idea what the product is you're buying a year down the line. That's part of the problem.
Yeah, and I think actually the interesting point here is also like the optimal world would be that you fix a rate, but then you at the same time can have multiple carriers behind that fixed rate, right? Because then you can actually start navigating the operational challenges. I think one of the things that we are talking to customers about is if you want to log in the rate, how do you then do it in a structure where it's, don't rely on just one carrier. Let's try and find a way where we can do it on multiple carriers and reduce that risk of the operational impact of blanks and so forth. And I think that's actually something that if I was, head of supply chain somewhere, I would look into to those options if I was deciding to fix a rate.
And just to add, I know we're maybe almost running out of time, but typically when people run RFPs, they tend to get to the lowest cost. And there is always that one carrier that is under the market. Let's just say market from Asia, Europe is 1,000, and somebody decides they're going to go at 900. That rate is in the market. That carrier may have 5% of the market. 90% of the market pays 1,000. I'm just saying hypothetically a number, right? So if your sole purpose of RFP is getting the cheapest price, you are likely going to get the 900. And that doesn't give you options that Trine just described. So maybe when you launch RFPs, make sure you have a clause that said you need 2, 3, 4, 5 carriers included in your price. And that's going to give you that certainty that your cargo will move no matter what.
Great point. Yeah. Okay, let's pivot to a bit more of a macro picture right here, and some of the events we're seeing currently, and also expect to continue into 2024. So let's start with you, Nerijus, on the top ones here. What are we seeing? What are we seeing in the North American market at the moment?
Yeah, the International Longshoremen Association, the ILA contract, which is a union contract covering the workers, port workers, terminal workers on the East Coast and Gulf Coast, expires after 6 years of validity at the, I believe, end of September 2024. It is a very interesting and important date. Now, historically, ILW on the West Coast was more strict, and ILA tend to sign contracts maybe a little bit easier historically. But the president already this year said, if we're not getting what we want, we are going to go on strike day one. There is not going to be an extension for 9 months, 13 months, 3 months. We want to get what we want to get. And they haven't even said what they want to get yet. Anyhow, it's very important to watch, because if there is a strike on the East Coast, it's going to affect very significant amount of U.S. freight. 35% of US cargo today is imported through the East Coast. 10%, 9.5 actually, Gulf Coast. Both of those are affected. That's almost half. And the West Coast is 55%. So something happens on the East Coast, all of that cargo will have to go somewhere. One of my recommendation is just, if you can, ship a little bit earlier. If you're shipping to the East Coast, try to advance some of your orders that they arrive prior to September to avoid some of that mess. And the second thing, which can easily be combined with point number one, is Panama Canal has seen very severe drought conditions this year. They are so severe that we haven't seen anything like this for 50 years plus. Today, containerized vessels are not yet affected that much. The average delay, I believe, is 1 day for containerized vessels. But that's just for the number of vessels. Panama Canal already doesn't accept, or not Panama Canal, it's the carriers. They don't accept heavy cargo. Some of them have restrictions at 6,000 kilos or 6 tons per TU. So if you're shipping more than 12, they say, no, you have to ship via Vescos and rail. We won't accept it. Simply because Panama has draft restrictions for ships. They used to be 50 feet, and now it's down to 44, and it's expected to go down more. Just to give you some numbers, what does it mean? 44 feet draft, if it goes down to 43 feet, that means on average, based on one estimate, the shipping lines will be able to load 350 TUs less. So if you drop it down by 10 feet to 34 feet potentially one day, then shipping lines will have 3,500 TUs less capacity per sailing. On top of that, and that's my last point, Panama Canal today allows 32 sailings or transfers a day. They already announced that as of February 1, it's going down to 18. They won't have more because the water conditions are extremely bad, and we are today in the rainy season and it's not raining. So it's truly a black swan event about to happen in the Panama Canal. Back to you.
Definitely something to watch out for. Yeah, great insight, Nerijus. What else is happening out there, Lars?
Yeah, before I dive in, let me just put one additional word on the Panama situation, because from a carrier perspective, to some degree, that's good news. Sorry to be the cynic here, because at least for the Asia to US East Coast, there is an alternative that goes through Suez. It's a longer routing, which will help absorb at least a little bit of the overcapacity the carriers are struggling with. So the Panama issue, if you're shipping from Asia to US East Coast, the main impact is going to be transit times will be longer. It's going to cost more. That's not the key problem. The key problem of a shipper is going from East Coast South America to West Coast North America, as well as from West Coast South America up to East Coast North America and Europe, because they might not be having any other options but to ship through Panama Canal. That will entail waiting times and likely also sharply increasing costs.
And to add Gulf Coast as well.
Yes, absolutely. In my mind, East Coast, Gulf Coast is one and the same. Sorry for not making that clear. In terms of the other elements happening out there, we have the war in the Middle East, now at least the war in the Gaza ongoing. There has been concerns out there, and that's also what this is alluding to. Oh my God, what if this impacts the Suez Canal? My take on that one is there is not a baseline scenario here. We're going to see a permanent closure of the Suez Canal. I do not see that as a realistic situation at all. The one risk we should have in the back of our minds, and again, it's an outlier, but it's there, would be, say, the conflict spreads a bit. You have people with RPGs shooting at ships in the Suez Canal. That would bring you back to an Ever Given type scenario where suddenly you have a vessel stuck in the Suez Canal. Is that disruptive? Sure. Is it a major disaster? It isn't, and it's actually easier to manage this time than 2 years ago, because now, as we just discussed, we got massive overcapacity. Should the worst happen and we got the Suez Canal blocked a couple of weeks, we actually have enough vessels to reroute everything around Africa. It's going to take longer, yes. It's going to be more expensive, yes, but we're not going to run out of capacity. So I'm not so concerned about the Middle East situation seen from a container carrier perspective. And basically still with the war in Ukraine, it's been ongoing for more than a year and a half now. And again, sorry to be the cynic here, from a container shipping perspective, the impact is marginal at best. We are indirectly impacted by higher fuel prices, but there are other elements that are impacting fuel prices more. Direct impact on the supply chain, unless you are actually in Russia or in Ukraine, the impact is actually fairly marginal. And on Russia, despite all the sanctions, this also shows how a global industry works. There are plenty of carriers that are shipping containerized cargo from Asia to especially the Black Sea ports in Russia, just not the carriers that used to do it before the conflict because they are embargoing Russia, but that's the slack is being taken up by other carriers from countries that don't have sanctions against Russia. Then we have the geopolitical challenges between China and the US. At least they haven't heightened in recent months. Let's put the positive spin on that one. If we see that one increase again, potentially intensifying, let's say, the trade war, from a container shipping perspective, that has very marginal impact. We saw it even back under the Trump administration when the trade war actually came and there were massive tariffs put in place. Yeah, it did have a negative impact on volume shipped from China to the US. But it also had a positive impact on the volume shipped from Southeast Asia to the US, which are still Trans-Pacific services, and lo and behold, also had a positive impact on the volume shipped from China to Southeast Asia. So while the geopolitical challenge is clearly there, I don't see that as a major potential disruptor. One thing I would highlight that's not on this one is actually what's going to happen in the European Union already here in January 24. If we talk acronym soup, it's called the ETS. In reality, it is the European Union's carbon taxation on shipping. It actually applies to all shipping, not just container ships. And this will be implemented, and seen from a shipper perspective, this is going to be completely intransparent and opaque. If you're hoping that you can get some insight into the new surcharges, we already have 5 carriers that have announced surcharges starting from January. There will be zero alignment, zero transparency. Alignment, no, because if the carriers were to align surcharges, that would be illegal collusion. It's just like with bunker. That's not going to happen. Transparency, well, here's the problem. The carriers are not being taxed per container. This is not a tax on the cargo, it's a tax on the ship. So at the end of 2024, in Q1 2025, I tell the Commission I emitted this much from all my ships. And then in September 2025, I go to an auction to buy carbon certificates. So I don't know until September 25 what the cost will actually be, but I need to put a surcharge through here in January 24. That is going to be completely intransparent. How I break down the emission from a ship to the individual container, all carriers have different methodologies from doing that. Furthermore, I am taxed on the journey from last port outside EU to first port in EU. So there is a huge benefit from rearranging my networks to have vessel calls in ports as close to the EU as humanly possible, because that will reduce the emissions that become taxable. This in itself would lead to significant changes in the network in and out of Europe. That then comes on top of any other changes we might have on the basis of the alliances breaking up. So for Europe, this is a challenge. And a final comment on that. If you are now sitting, for example, in the Caribbean and saying, this is not for me, well, think again. Some of the EU countries have overseas colonies. Some of these colonies are technically part of the EU. So you will be liable for EU carbon tax in places like Réunion in the Indian Ocean, or Martinique in the Caribbean, or French Guiana on the north coast of South America.
That's a great call out, Lars. Another significant event definitely to keep an eye out for in the beginning of next year. Another trend we're seeing is essentially the development of exports going out of China and into Southeast Asia and the Indian subcontinent. In fact, the last 3 years alone, we've seen the Indian subcontinent and the Southeast Asia take 5% share from China. How do you see this, Nerijus? Is this going to continue? And any sort of tips and tricks out there for importers?
No, it absolutely will continue. This is not a new trend. If you look back 10 years, that share has been growing for Southeast Asia and Indian subcontinent. If you look at GDP forecast, for example, for next year for India, it's one of the highest for at least Southeast Asia countries. I think it's 6.3% is what's forecasted for next year. With geopolitical challenges in China and some countries trying to avoid single sourcing, right? Southeast Asia has been market number one. Vietnam, easy choice, right? A lot of companies shifted to Vietnam. Now we're seeing more and more companies shifting to India. So I would predict that the container ship growth from India will actually be more than the GDP. GDP versus container freight correlation is typically 1-to-1. It used to be less years ago. I think Lars has an opinion on that one. We'll ask in a second. But I believe in India that's going to be more, and I would predict it may be as much as 2, which would mean India may be growing as much as 10-12% next year. Carriers are also discussing potentially adding more capacity from India. So it's good news for importers. Something to watch out for if you're shipping from Southeast Asia and Indian subcontinent. You're better off being on US East Coast and West Coast. The transit times are shorter and the price is typically better. Back to you, Anders.
Yeah, no, those are great points. Anything to add there, Lars?
I think the outline for the region, I haven't got anything to add there. The one thing I will add, it also speaks into what has been a headline topic for the last few years. Are we going to see nearshoring? I mean, when people move out of China, are we going to see production move back to North America, back to Europe? And I've been looking at that and looking at the numbers over the last few weeks. And whilst anecdotally, you can certainly find individual companies that have done it, when you look at container volumes, there's absolutely no sign of nearshoring whatsoever. The average sailing distance of containers moving into these regions is unchanged. The share of intra-regional cargo versus deep sea cargo, if anything, is dropping. It's not increasing. And I think this slide explains pretty well what is happening. We are not seeing nearshoring. We are seeing reshoring. And the Indian subcontinent is going to be the growth engine for container shipping, basically for the remainder of this decade.
Yeah, very true. The onshoring, nearshoring numbers don't really show in the numbers. Okay, let's keep going. We're seeing some other trends here on the Trans-Pacific. This is sort of a pattern where we've seen, the West Coast share taking a hit, and it's now back up to historical averages. What's interesting to call out, though, is the rate spread between West Coast and East Coast is actually the lowest it's almost ever been. Lars, is this to expect it going forward, or would you expect the rate gap between East Coast and West Coast to widen again?
No, I'm not necessarily sure that the gap will widen. The issue here is the rate gap has narrowed because it's become more attractive now to ship into the West Coast. That's also what we saw in the numbers early on. The West Coast rates are fairly strong, whereas the East Coast rates are relatively weak. And if we look into a 2024, where we have the ILA potential strike on the East Coast, we have the Panama Canal challenges, that will mean that there will become an increasing pressure on the West Coast, which will again support that, relatively speaking, West Coast becomes more attractive than East Coast, which would tend to keep also the rate spread at the lower level that we're seeing. Long term, no, such a low rate spread is not sustainable, but for the foreseeable future, that could very well be the case.
Yeah.
I would just add that for 2024, I fully agree that West Coast is going to be the winner, right? A lot of people are going to be looking for contingency plans for like what may happen. We've shown there's a lot that may happen. But if you look long term, next 10 years, I really believe that Eastern Gulf Coast will continue growing. 6-7 years back, Gulf Coast had 2% of US share. Now it's 10. I think it's going to continue growing again. And the main reason why is Southeast Asia and India is growing. And when those markets are growing, they're simply better off going to the East Coast. Yes. It's true. Next year, West Coast may regain as much as, it's a brave guess, 10%. It's a lot. I do think it's going to be a mess on the West Coast because a lot of companies are going to be doing something. But long term, I think the trend will continue and East Coast ports are going to be the winners. But I'm talking very long term.
Yeah, no, I would tend to agree with this. And let's all keep in mind the problem on the West Coast is not the ports. The problem is how do you move the stuff inland from the ports once it gets discharged?
Yep. And rail contracts are high as they've ever been.
Okay, let's pivot. We've been warming up to this topic throughout the whole webinar, so let's get to it, Trine. We've been hearing lots of news on essentially the European Commission digging into the setup of the ocean alliances. So, what does all this mean? Help us dumb it down.
Well, let's just say that the European Commission is pretty busy these days. So on top of ETS that we referred to earlier, then there's also this new ruling that has come into play. And to just be very transparent, it's not a very easy ruling to comprehend. And so far, I think very few, even from the carrier side, know exactly what this will result in. But the essence of it is that for anything touching the EU, there has been, so there's an anti-competition law in the EU. I think that exists in many places, including the US as well. But there's been an exemption for carriers where there has been extended rights in terms of collaboration as long as it would benefit the consumer and the public and general infrastructure. And the EU has recently decided that this exemption will no longer be in place for carriers. And I think, Lars, I've seen a few of your LinkedIn posts, and I know that you have read through the whole EU ruling on this. I tried to read a little bit, and still I find it very complex. So I'm quite curious to also hear your view on what will happen, because I think when I read it, I'm like, okay, what will need to happen to alliances? Can they still operate like they do today? Vessel sharing agreements, so where they put, vessels, two carriers put vessels into one string, can they continue to operate that like normal? Or will they really have to redesign all the networks that touch Europe on the basis of this ruling? So I'm curious to hear what you read from the ruling.
Yeah. On the basis of the ruling, it's clear that there is mass confusion. There is a huge gap in the understanding of the rules, both the old and the new rules, between the regulators on one side and the carriers on another side. And that's not just an interpretation on my side. Specifically in the document, the regulators write explicitly that the carriers have an incoherent and inconsistent understanding of the rules. That's pretty damning. The problem here is the regulators are not necessarily the arbiters of truth either. This is a field where there is no legal precedent. So if there is a difference of opinion on how to interpret the rules between the carriers and the regulators, somebody would need to take it to court, which is going to probably take the better part of 5 years plus and cost an enormous sum of money. That's one of the issues. Another one of the issues is there's also a difference in understanding of how do you calculate market shares, for example. The way the regulators have done it is if you have a consortium that is, for example, an alliance that operates on multiple different trade lanes. If you're above 30% in just one trade lane, you're by definition above 30 in all of them, and 30 until now has been the magic number. But that leads to the very, very weird situation that most of the consortia, and that also includes the alliances, have for years been above 30%. But that also means for years, this rule has not applied to them. So if you abolish this rule, it doesn't mean anything because the rule didn't apply to them in the first place. That sounds weird because the carriers have been lobbying for 15 years to keep the rule because it was important to them. Now we're being told it doesn't matter because it doesn't apply to them. The shippers have lobbied to remove it because it was stifling competition, yet actually it didn't apply for 15 years. And again, that just boils it down to huge cloud of uncertainty. What exactly is here? And I don't envy the carriers the situation they're in, because on one hand, they certainly could make the interpretation, since we already were not covered by this rule for years, we can actually continue the alliances as is. That would be a perfectly correct assessment. On the other hand, ask yourself this: if we now abolish this rule, which the EU is doing in April next year, and the carriers change absolutely nothing, what legal cases will suddenly be brought against the carriers? That is, again, a level of uncertainty that would be hard to deal with as a carrier. My own assessment of this is the uncertainty alone will lead to the carriers, and hereby also the alliances, changing some of their networks, changing some of the networks that they're collaborating in. But it's very opaque right now exactly how that's going to pan out.
Thanks, Lars. Very clear, or I guess rather unclear in terms of what exactly is going to happen.
The more you read into this catastrophically boring 81 document, the more confused you will get. It creates absolutely no clarity.
So a huge cloud of uncertainty on exactly what's gonna happen here. What we do know is that the 2M alliance, Maersk and MSC, have decided to split ways in 2024. So a lot more to unfold with this. So stay tuned for more update. We'll probably dedicate a webinar on this later once we know a lot more here. But in the meantime, before we run out of time, let's have a look at some other recent changes we're seeing in the market. It seems like fastboat or so-called premium services are having a comeback. We've seen a lot of announcements lately with carriers announcing faster services. Nerijus, what do you see here?
So just real quick, the premium services have been in the market for a while. They are actually adding value, right? They typically take cargo away from air freight because they cut transit time, not just at ocean freight. If you take your Ferrari of premium services, Matson, right, or APL, CMA, EXX, those services they have 1 day cutoff, 10, 11 day transit time on ocean, 1 day discharge, quick transfer on rail. So it quickly adds to enormous savings for the importers. The part of the issue was that in the last few years, there were a lot of fake premium services in the market, and they kind of lost trust. It was basically a way to get on a ship when the ships were full. Forget that. That is not premium. The real premium services out there, for the listeners, I want to just announce that more of them are there. Give it a try. It is going to save you time. It's no longer just from Shanghai. Shipping lines are now launching premium services from Yantian, Xiamen, and those are real. They will save you time, and it'll probably be a good alternative for air freight. It will save you lots of time, will save you lots of headaches. And ask yourself a question, or ask your logistics teams if you are in a different team, how many times was your cargo rolled in the last month or two? Probably quite a few. This also guarantees that your cargo doesn't get rolled, that you're going to get exactly on a boat you booked, it's going to sail on time and arrive on time. And all these blank sailings we discussed earlier, this is a way to avoid those mini peak seasons that follow a blank sailing, right? When you have a blank sailing the following week, you have more cargo than anyone can handle. So again, take a look. It's working. It's worth a try.
Yeah, definitely ensure you familiarize yourself with these. These are great alternatives to air freight. It can essentially save you up to 10x the price of air freight, especially when you put less than container loads on some of these premium services. So a good alternative right here. So let's wrap it up. We're running out of time, but want to make sure we leave you with some key recommendations and takeaways based on what we've been hearing in this webinar, but also just in general. So Trine, over to you in terms of what you recommend any importer, any shipper out there to hone in on in 2024.
Yeah, so I think we have touched upon a few topics here, right? But one of them is think about your rate strategy in terms of your business. Maybe it's worthwhile to even diversify it across fixed, floating, and index-based contracts. Carrier strategy, be careful with backing only with one because of all the operational challenges there. You can use the transit time and preferred services or priority services as an alternative in the current market that can save you a lot of cost. And then I think, some of the things we haven't gone too deep on in this webinar, but technology in these days is a good advantage. It gives you speed, it gives you visibility and transparency in a very challenging market where resilience is critical. we've tried to use a crystal ball today, but as you probably all know, what we don't predict is probably what will impact your supply chain the most in the coming year. So having the right level of visibility and the speed to manage that, I think will be critical. And then, as Anna said, less than container load, that's also a great option, especially on the priority services as an alternative to air freight. I think all companies these days are trying to reduce cost. So, that is an alternative. So we look forward to 2024. I think it will be interesting as always. That's kind of my interpretation.
Indeed, you never know what's going to happen in the world of shipping. On that note, thanks everyone for dialing in. We're right at the hour here. Thank you so much for all of your wealth of knowledge, Trine, Nerijus, and Lars. See you all later. Bye.
Thank you.
Thanks, everyone. Bye.